So on investment markets, we've had a very busy 2 to 3 weeks. So obviously COVID-19 or coronavirus is still dominating headlines, and we've seen local and international markets down anywhere between 8 to 11% on global share markets since our last video update. And big news yesterday was that the Reserve Bank also cut official interest rates again by 0.25% to 0.5%. This is the lowest it's been for a number of decades. And in the Reserve Bank, their commentary, they were saying that basically they see this is a bit of a preemptive stimulus for the economy to give it that interest rate cut to try and help businesses and people with loans adapt to potentially slower economic growth. They're still saying it's not yet known in the next 9 to 12 months how much COVID-19 will affect on Australian and economic growth, but we already know our education and tourism sectors are taking a hit domestically. So what I want to do is actually talk a little bit about why it is that when we have a market correction like this, we don't do a knee-jerk reaction and just go and sell out of the share market. The coloured bar chart shows what allocation a portfolio would have to volatile assets such as shares and property. And for the example of what we would call a growth investor, they'd have around 80% of their portfolio allocated to these assets. And in a worst case scenario, their portfolio could be down negative 40%. But over the long term, they'd have a return of around 7% per annum. Whereas if we look at a moderately conservative investor, which would have around 40% of their portfolio to volatile assets such as shares and property, worst case scenarios they could be down 19% but have an annualised growth rate of around 5.7%. And to put into context, these worst case scenarios are what an investor may experience over a typical 10-year investment cycle or an economic cycle. So in summary, I hope that helps you understand how your risk profile and how the asset allocation in your portfolio is actually designed to help you weather volatility that we've seen in the last 2 to 3 weeks. And it really is going back to the fact that all investing we are looking at with a medium to long-term outlook. On another note, we had CoreLogic released some house price data for the Australian residential property market. Housing values again are up around 1.1% over the last month, with 5 out of 8 of Australia's capital cities recording growth. The two clear winners are still Sydney and Melbourne, followed by Brisbane as to performance for the last 12 months. So the housing market continues to be strong, and a few of those markets like Sydney, Melbourne, Brisbane aren't too far off from their previous peaks that were made in 2017 and may shortly be breaking new ground again. So that was some data that came out in the last week as well. So there you go. That's a quick little wrap up of what's happening on investment markets. As always, if you've got any questions around your strategy and your portfolio, please always pick up the phone and give me a call.